Welcome to The Explainer. Today, we're going to tackle a topic that, let's be honest, can feel a little complicated for all of us: your income tax for the 2025-26 financial year. Our goal here is to turn all that complex jargon into simple, clear knowledge that you can actually use.
So, if you've ever felt like the Indian income tax system is a bit of a maze, especially with things changing almost every year, well, you are definitely not alone. And trust me, you're in exactly the right place to get some real clarity.
All right, let's jump right in. Here's our game plan. First, we'll look at the new tax rules. Then we're going to walk through exactly how to calculate your income, and we'll make sense of the tax slabs and these things called rebates. After that, we'll demystify a super important concept called marginal relief. And finally, we'll wrap up by looking at some key deductions you really don't want to miss out on.
Okay, first things first, the new tax rules. Before we can even think about doing any math, we have to understand the foundation of the whole system, and that means getting to grips with the new tax slabs that are now the default for everyone in 2025-26.
Now, I know what you're thinking. This is a page straight from an official government document, and it looks a little intimidating, right? Don't worry about all that text. We're about to pull out the most important part, the tax rates, and put it in a way that's much, much easier to understand.
See? Much better. What's really key to understand here is that our system is progressive. That means you don't just pay one flat rate on everything you earn. Think of it like a ladder. Your first 4 lakh rupees, completely tax-free. Then the next chunk of your income gets taxed at 5%, the chunk after that at 10%, and so on, all the way up.
And that brings us to step 1 of our calculation, figuring out your actual taxable income. Because before we can use those slabs we just saw, we need to know the exact number to apply them to. And it's not just your total salary. There's a really important first step.
So, the first thing you got to do is add everything up. Your salary, any bonus you got, maybe some rental income or interest from your savings account, all of that gets bundled together into what's called your gross income.
And this is where the good news starts. Under this new tax system, there's an automatic little discount built right in for every single salaried person. You get it right off the top.
And here's that magic number, 75,000 rupees. This is the standard deduction. If you're a salaried employee, you just take your gross salary and immediately subtract this amount. The final number you get is your taxable income, and that's what we use for all the calculations going forward. That's a simple but really powerful benefit.
All right, on to step 2, the slabs and rebates. So we have our taxable income number. Now we can finally apply those tax rates we looked at earlier. But hold on. There's another amazing feature here called a rebate that for millions of people literally brings their final tax payment all the way down to 0.
This absolute game changer is called the tax rebate under Section 87A. It's actually pretty simple. After you do the initial math using the tax slabs, if your taxable income is 12 lakh rupees or less, the government essentially gives you a discount that just wipes out your entire tax bill. It's gone.
This slide shows you the pure power of that rebate. It's like an on-off switch. If your income is up to 12 lakh, boom, your tax is 0. But if your income is even 1 rupee over that limit, that rebate just vanishes, and suddenly you owe the full calculated tax. And this sharp cutoff creates a pretty interesting problem.
And that problem brings us perfectly to step 3, marginal relief. I know the name sounds a bit technical, but just think of it as a safety net. It's a special rule designed to fix that exact cliff edge problem we just talked about and prevent a really unfair tax jump.
I mean, think about it for a second. Imagine you get a small raise at work. You're happy, right? But what if that tiny bit of extra income suddenly means you have to pay a massive tax bill? You could actually end up with less money in your pocket than before the raise. That just doesn't feel right.
Let's put some real numbers on this, because this is where it gets a little crazy. Let's say your taxable income works out to be 12 lakh 80,000 rupees. So, you earned 5,000 rupees more than the tax-free limit. Because of that, your tax bill jumps from 0 all the way to 60,750 rupees. You earned an extra 5,000, but now you owe over 60,000. That's what we call the tax trap.
And this is exactly where marginal relief comes in to save the day. It's a common sense rule that basically says, hey, your tax can't go up by more than the extra income you earned. It just smooths out that huge unfair jump.
So let's go back to our example. For that person earning 12 lakhs 80,000 rupees, marginal relief kicks in, and instead of paying that crazy 60,000 rupee tax bill, their tax is capped at the extra income they earned above the limit, which was just 5,000 rupees. It makes the whole system much more logical and fair.
All right, we're on to our final step,
unlocking key tax deductions. Now, one of the big ideas behind the new tax regime was to make it simpler, with fewer deductions to worry about. But that doesn't mean they're all gone. There are still some really powerful options you can use to lower your taxable income. You don't have to read all the fine print here, but as you can see from these actual pages of the Income Tax Act, there are entire sections of the law dedicated to specific allowable deductions. The trick is just knowing which ones apply to you. So, let's just quickly run through some of the most popular ones. You've probably heard of Section 80C, that covers investments like life insurance premiums and PPF. Then there's Section 80D for health insurance. 80CCD is for your contributions to the national pension system. And 80E is a big one. It lets you deduct the interest you've paid on an educational loan. Each of these can make a real dent in your final tax bill.
Okay, let's put it all together. Here's your quick 5-step cheat sheet. 1. Figure out your total gross income. 2. Subtract that 75,000 rupees standard deduction. 3. Calculate your tax using the new slabs. 4. See if that awesome Section 87A rebate or the marginal relief safety net applies to you. And finally, step 5, you've got your final tax bill.
So that really brings us to the most important question of all. Now that you actually know how your tax is calculated, how are you going to plan your finances for the year ahead? Because the goal isn't just to pay your taxes, it's to understand the system. And that understanding, well, that's the first step to making much smarter decisions with your own money. Thanks for watching.